UK inflation for March has dipped to its lowest level in 4 years. Stephen Lewis of Monument Securities joins me now. Stephen, walk us through the contributing factors to this figure.
The main factors have been the restraint in administered prices. University tuition fees went up rather less this year than in the previous year and less than expected. And utility charges have been capped by government policy. Both of those influences have helped to keep inflation down. In the background, of course, there is the sterling exchange rate, which has been very strong and which has helped to limit the increase in import prices. Indeed, for raw materials, import prices have actually been falling, which has helped UK manufacturers to keep their costs down. The figure that came out today relates to the month of March, and there is a significant seasonal effect this year because this year Easter is very late. Last year, though it was in March, prices generally rise around Easter, so we're comparing a relatively low March figure with a high base last year, and that's making the year-on-year change look lower than the underlying rate actually stands at.
The IMF warned Britain last week that the UK economy remains too reliant on consumer spending. Does today's confirmation that average wage growth and the rise in prices has continued to narrow perhaps soften this concern?
It softens the concern that maybe consumers are running down their savings in order to support spending, but I don't think that was the main influence anyway. I think the chief factor pushing up consumer spending has been the fall in unemployment, because this has meant that people who were living on benefits are now earning wages, and those wages are probably very much higher than the benefits they were receiving, so that this gives them more spending power. So that does help keep consumer spending moving along. I think the IMF was a bit unfair because the capital spending numbers have been quite strong recently also, so that gives another engine of growth for the UK. The only problem there is that the capital spending figures are always subject to revision, and these could be revised downwards eventually.
You touched slightly on this already, but if we combine these figures with a stronger pound, how does this play out for the sterling's purchasing power?
Well, one would expect there to be downward pressure on import prices from the stronger pound, and export prices are still rising relatively rapidly because the UK's inflation is still stronger than that of most advanced economies. So this is giving a positive terms of trade effect, which should be supportive of growth in domestic demand in the UK. But that's a situation that is likely to be no more than temporary. That kind of terms of trade benefit generally reverses itself when the current account goes badly wrong, as it seems to be doing.
On Monday, economic forecasting group the EY Item Club predicted average earnings could rise faster than the cost of living in the UK as early as this month. With domestic businesses footing that rise, how does this bode for Wednesday's unemployment figure?
I don't think domestic businesses would be paying these higher wages unless they were seeing the demand to support it. So they are getting a benefit from spreading these costs over a wider volume of output. So that should help in keeping their cost equation in order. If the cost equation is in order, then they wouldn't be under any great pressure to shed labour. If demand is picking up, then shedding labour would be the last thing that they would want to do. They're more likely to want to hold on to it. But we did see some very strong rises in employment last year, and maybe we need to see a period where the labour market stabilises for a bit before demand for labour picks up again, because some employers may have surplus workers that they've hoarded in anticipation of better times to come.
Stephen, thank you. I'll be back tomorrow with a look at US housing. From me, though, it's goodbye for now.